This is alarming. I'm your host, Steve Metre, and thanks for joining me today. And our lead story today, New York has fallen. I'll show you what's going on in the Empire State and why what's coming will shock you. Plus, a major company is about to send their stock price crashing. I'll show you why and how other companies may soon follow. And one bank is starting to flag that there's cracks in the U.S. economy. I'll show you why what's happening is this bank has preceded each and every recession. Now let's over to Bloomberg, where we picked today's story up with a headline: as New York manufacturing contracts, as orders and shipments weaken, as we see now New York has fallen in the manufacturing sector, now back in contraction. The Federal Reserve Bank of New York's October General Business Conditions Index slid 23.4 points to a 5-month low of minus 11.9, and readings below zero indicated contraction being weaker than all estimates. And this is crazy, because when we talk about the manufacturing sector in New York falling here, what it suggests is we're going to see in every major region of this country manufacturing further contract. Because when we talk about a no landing or soft landing scenario, what you want to see is manufacturing rebound. And this is what everybody said would happen. They said that not to worry, it's the services sector that would lead manufacturing. We said not a chance. Where manufacturing goes, services will follow. We've noted that demand was getting weaker, and it's about to get even worse, as you're about to see. And when we look at the current general business conditions index for New York, you can see kind of the soft landing narrative take hold here as we see the diffusion index rising, and then all of a sudden it plummets down. It's going to get much, much worse. As a measure of the current new orders dropped nearly 20 points to minus 10.2 after climbing a month earlier to the highest since April 2023. And this is something we talked about, that many people were excited about, the booming economy that was coming. The Fed rate cuts would make a difference. That as soon as the election would end, wallets would open and money would flood into the economy. And so what we saw in the manufacturing sector is if you build it, they will come. And a lot of manufacturers built up their inventories. Wholesalers did, retailers did, and now what they're finding out, demand isn't there. That's why new orders are crashing, because consumers are in dire shape, as one bank is pointing out. The employment index, however, rebounded to 4.1, the first expansion in a year, and the measure of hours worked also climbed. So once again, we see manufacturers staffing now back up on hope that they believe that something's coming, something's going to change. And is this just simply the placebo effect of a Fed rate cut that's now on the books, and perhaps more to come as we look forward to November and December's FOMC meeting? And yes, this is entirely possible, because the Fed and the media have created such a hoopla over this that everyone really believes that if you cut rates, that suddenly the economy transforms itself. Yet most households, yet most individual people have no clue what a rate cut does to their finances, but yet the world believes it. And meanwhile, the New York Fed's gauge of prices paid for materials increased to a 6-month high of 29, suggesting that inflation is hitting into the producer sector, while an index of prices received by state manufacturers also accelerated, indicating that they're able to pass on some of these higher prices. The reality is they can't keep passing those prices on for much longer, because what you're about to see from U.S. consumers, what this bank is warning about, well, stay tuned, because it suggests that we're going to see a manufacturing crash across region after region. At the same time, the 6-month outlook for overall activity increased to a 3-year high of 38.7. And mind you, this is a very high print, indicating the state's manufacturers are more upbeat about the economy's prospects. Begging the question is, what are they upbeat about? Is this simply the rate cut narrative, that if you cut rates, that again, there's going to be this surge in spending from consumers and businesses? But is it also about the election? Is it as soon as the election passes, people are going to start spending money like crazy because they're so uncertain right now? The reality is, it's neither of them. We can look back to prior elections to see virtually no impact on the economy afterwards, and we can look at rate cuts and we can see, well, that doesn't lead to spending at all. But what it does lead to is optimism. As we look at future business conditions here, the index for New York, and you can see right now this thing is just surging higher. But let's go back to 2006 and 7 when we get into the first Fed rate cut, and you can see the same effect happening seeing here is future general conditions were surging higher on the hope that the Fed was soon going to cut rates. The Fed starts to cut rates, business conditions stay elevated, and next thing you know, they come plummeting down as optimism gets wiped out. And we look then forward here around 2019, which is what we're seeing now, a repeat of U.S. consumer habits. We'll talk about that in a bit, but look at this. You see the Fed cuts rates, it causes a surge in future general conditions, and then it plummets as reality of the economy sets in. And right now, hope is driving manufacturing, but what it's not driving is spending. And the problem right now is one major company, we talked about this yesterday, could send the economy into recession because right now, due to a strike, they're shut down, and that means they're about to send their stock tumbling in a big way. And what you're about to see here is something that other companies are going to be forced to do in the next recession. I'll show you why, because Boeing to raise as much as $25 billion to stave off cash crunch. And the issue here is Boeing is such a huge manufacturer that they pull from regions all over the country. So when they're shut down, well, manufacturers, their hope is going to get dashed because they're going to see their new order book decline in a big way. And this is going to have major repercussions to the entire U.S. manufacturing base. The company on Tuesday filed with regulators to sell any combination of bonds and shares known as shelf registration. Boeing is looking to shore up its balance sheet and boost its access to cash as it tries to avoid getting cut to junk status by bond graders and facing much higher borrowing costs. So one thing we're going to see during the next recession is companies are going to be desperate for cash. The difference is during recessions, banks tend to cut off their lending activities, and what we're going to see is they're going to be forced to issue a lot of stock. Now, one of the problems here is Boeing was a prolific buyer of its stock. Back during the high times where stock was flying, they were buying billions and billions of dollars worth of stock back, believing that nothing bad could happen. Now, all of a sudden, due to the strike and due to massive amounts of debt, they're being forced to look at issuing stock. And you can better believe if they start doing it, the reaction is going to send their stock plummeting. But the challenge as we go into the next recession here is a lot of companies are levered up in a huge way. They've got massive amounts of debt, and they've been encouraged by Wall Street to take what cash they did have and buy their stock back, leaving them in only one position. That's going to be issue stock on the way down, which could send the market outright plummeting. But one thing that should be headed higher is your trading accounts. We look at this recent trade. This went on the books on October 7th to our Momentum Timer Pro subscribers. If you're looking to trade momentum, or you've been trying to those technical signals like the RSI, the MACD, and you can't get it right, you get in late, you're getting out early, you're all over the place. Well, we aggregate them together. We run a proprietary overlay, and pretty soon we're going to have our full back-tested results for our subscribers. But look at this. On October 7th, it said it's trading above every volume profile line I trade. Buy at open. Here you are. Look at this. As of close of business yesterday, this trades up 2.52% and surging higher today as banks put out huge earnings. But where are we at overall? We're at CTA Timer Pro, where we're trading against the machines. Now, we've got some positions that are coming up pretty soon that are going to be flagging. Right now, we closed one trade yesterday. That was up 4.07%. We added a trade today. We're sitting on a 50% win rate, which is still very impressive. Momentum Timer Pro, we've got 6 open trades, sitting on a 50% win rate, and we think that bank ETF is going a whole lot higher. And it's so easy for you to make money trading. You get the daily reports, I get you all the signals, but I go through each and every one of them and give you my opinions on the ones you should be looking at. We have full back test data on CTA, and we have some big news coming on it soon. We give you stop loss levels, we track the trades and returns, we give you weekly updates. It's fully duplicatable and a 30-day free trial. The only excuse you have is you got to go click on the links below and sign up for the report. Start trading, start making money. Because Boeing revealed late last week there's only a small buffer on top of the $10 billion of cash in short-term securities it needs to avoid slipping to junk status. So again, you talk about the importance here and why we're going to see lots of companies being forced to issue stocks, particularly after they wasted tens of billions of dollars buying their company stock back. As we see the economy hit a recession, they're going to be forced to raise cash. They're going to have to go to the equity markets because, again, the banks are going to cut everyone off just like they always do. The strike by members of Machinists Union in the Pacific Northwest, a crucial hub of Boeing aircraft production, is costing the company more than $1 billion a month, even after cost-saving moves, according to a recent estimate. And here you can see why things are going to get worse for New York, why we're going to see things get worse for other regional manufacturing, because when you look at the current general business conditions index for New York and you overlay the current new orders diffusion index, well, they look nearly the same. And based on just what's happening with Boeing alone, what it suggests is new orders are going to crumble. But that's not the only reason we're going to see new orders crumble. It's because U.S. consumers are in dire shape. Let's take a look at some recent news now that's hitting some major companies throughout the U.S. Is Walgreens to shutter 14% of U.S. stores to offset weaker demand. And that's the key words here, weaker demand. That's not where you get new orders from. You need new orders. You should be opening more stores, not closing old ones. And Walgreens' retail division has struggled as budget-conscious consumers turn to online retailers like Amazon and discount giants Dollar General and Costco. Competitive pressures led the Deerfield, Illinois-based company to lower full-year guidance for the second consecutive quarter in June and announced store closures, which caused its shares to plunge. But not to worry, the company said it finally would redeploy the majority of its workforce in stores that are closed. Well, at least those who are willing to move to another store. You can better believe this is going to lead to further unemployment. The other factor here is if you're opening stores, you're hiring people. If you're closing stores, well, you're going to be getting rid of people. But they're not the only company. As we turn to wholesaler True Value, who's in bankruptcy to sell itself to its rival, and the company faced significant liquidity challenges. So here you see at Walgreens what happened. They're saying weaker demand, and now we turn to True Value. What problem? They're having liquidity, meaning they're short on money, and so they hired financial advisors to review its options. And True Value is the latest firm to seek Chapter 11 protection as inflation impacts household spending for discretionary goods in the U.S. Home, clothing, and hobby store chains dominate the list of distressed retailers, this according to Moody's ratings. And what this means is many companies, again, are going to be forced to issue stock as we're heading to recession, as the market's going down. And this could drive stocks down farther than anyone expects, because right now the narrative is stocks are immune from a recession. Do you believe that or not? Weigh in the comments below, because we see more stress from U.S. consumers. From is Pepsi snack slump a sign of something deeper? Well, Walgreens is saying demand's down. We got liquidity crisis at True Value, but look at this. In recent quarters, have seen a decline in snack consumption. Food executives attributed the pullback to various causes, including pressure on consumer budgets from years of cumulative inflation and a general normalization after years of outsized growth in snack sales. But the bottom line is pressure on consumer budgets who cannot afford higher prices leads to weaker demand. And all this then points to problems in the banking system that are starting to build. But those aren't the only companies. We've got another one. How about this? As Goldman issues a grim outlook for AutoZone, citing significant exposure to struggling working poor consumers, and again, demand falling here, as Goldman's team of analysts said that AZO will likely see muted growth over the next few quarters. She noted that the auto parts retailer's customer base is highly exposed to working poor customers, which elevated inflation and high interest rates could, not just could, are crimping spending from this group and will likely impact sales through the winter and into early 2025, perhaps even longer as we head into a recession. And this is why we saw on the recent consumer confidence report that we see that lower income cohorts, their confidence is plummeting, and that's bringing down slowly the other income groups, because when the poor run out of money and stop spending, well, it eventually affects everyone. And this is exactly what we're seeing in bank balance sheets today, as one major bank has reported that there's problems with the underlying economy. We saw this happen last time going into 2019. We see this happen with every recession, and it has everything to do with the fact that consumers are running out of money because the economy is running out of money. And while investors are celebrating earnings, setting the stock price higher, and while our subscribers are taking advantage of it, look underneath the covers as Bank of America trading results beat as net interest yields hit cycle lows. But charge-offs, there's a big one, unexpectedly hit 11-year high. And it wasn't just a net interest yield that left much to be desired. Similar to JP Morgan, B of A's provision for credit losses unexpectedly rose to the highest in years and was $1.54 billion in Q3, higher than the $1.53 billion estimates. This was the highest now since the COVID crash, as banks are starting to price in that more consumers are going delinquent and are going to end up defaulting. And charges also rose to $1.534 billion, above the $1.5 billion estimate. This may come to a surprise as anyone looking at the stock, which is still up, but not for long, and thinking that the results were somehow much better than expected. But what we're seeing at Walgreens, True Value, and AutoZone all come back to the consumer. Here we look at real retail sales. This is inflation adjusted in blue, shown on a year-over-year rate of change against the delinquency rate on credit cards. And while we're going to get an update on retail sales, and many think it's going to surge higher, keep in mind, when consumers run out of money, they stop paying on their bills. You see delinquency rates rise, and what that means is real retail sales are headed even lower, which suggests the problems we're seeing in the U.S. manufacturing sector are a sign of weakening demand. What we're seeing at Walgreens, True Value, AutoZone, all signs of weakening demand. And what Bank of America is flagging is that we're now headed into recession, because this is exactly what happens each and every time. When central bankers invert yield curves and money curves, the economy eventually runs out of money, and then it's game over. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.